My name is Roger Porter, and it's my privilege to welcome you to this forum event at the Kennedy School of Government. The term crisis is one that is frequently used and often abused in our time. Students at the Kennedy School and at Harvard are taught to use terms with precision and accordingly tend to be more sparing in referring to situations as crises. Indeed, careful scholars often adopt a definition of a crisis as a situation in which one is able to successfully assert, that is, get other people to agree with you, that failing to act now will result in a significant deterioration in the underlying situation. By that definition, President Bush, Senators Obama and McCain, the congressional leadership in both the House and the Senate, on both sides of the aisle, and scores of eminent economists have concluded that the United States is now facing a financial crisis. The evidence they offer is compelling. The collapse of three major investment houses, Bear Stearns, Lehman Brothers, and Merrill Lynch, along with the nation's largest insurance company, AIG, and both Fannie Mae and Freddie Mac, the huge government-sponsored enterprises established to fuel the housing industry. As the angel Gabriel in the play Green Pastures remarked, everything nailed down is coming loose. We've come to discover what a wise man once said, the way in is easy and the way out is hard. This series of events prompted Treasury Secretary Paulson and Federal Reserve Board Chairman Bernanke to recommend to President Bush that he ask Congress for $700 billion to buy mortgages and other assets that are clogging the balance sheets of financial institutions and to establish a program that will allow companies to insure their troubled assets. This three-page proposal was first considered by the House of Representatives and voted down. Last night, the United States Senate, with a majority of Republicans and Democrats voting in favor, passed the Emergency Economic Stabilization Act of 2008, now a 450-page bill, with an additional $100 billion to extend provisions in the tax code that are set to expire and to increase the amount of deposit insurance to $250,000 per account. The vote was 74 to 25. Tomorrow, the House of Representatives intends to take up and may well vote on the measure. Well, how did we reach this point? And what should we do now? To help us consider these questions, we have a distinguished panel that includes three of our leading economists at the Kennedy School and a prominent journalist who is on her way from Logan Airport, and we are saving her a seat. Their background includes not only decades of scholarship, but also experience in the arena, serving in senior positions in the Department of Treasury and the Council of Economic Advisors. We're fortunate to have them and grateful that they have made time to share their insights with us. Because the subject is large and our time is precious, I'm going to simply introduce each of them very briefly. They will then each take 7 to 10 minutes to explain their version of how we got to where we are and what we ought to do, and then we will open it up for your questions. On my far left, Jeffrey Frankel has spent his life going back and forth on the two coasts of the United States. He was born in San Francisco, came back to study for his undergraduate degree at Swarthmore, then moved to get his PhD at MIT, then went back to California and was on the faculty for nearly 2 decades at the University of California at Berkeley. In 1996, President Clinton nominated him to serve as a member of the Council of Economic Advisors, and in 1999, we were fortunate enough to attract him here to the Kennedy School, where he is the James W. Harpel Professor of Capital Formation and Growth. Ed Glazer is the Fred and Eleanor Glimp Professor of Economics in the Faculty of Arts and Sciences, where he has taught since 1992. He was born in New York, trained got his PhD in economics at the University of Chicago. We attracted him here to Harvard, where he has been since 1992. In his spare time, he is the director of the Taubman Center for State and Local Government here at the Kennedy School, the director of the Rappaport Institute of Greater Boston, and edits the Quarterly Journal of Economics. Robert Glauber, to my immediate left, is a adjunct professor of public policy at the Center for Business and Government here at the Kennedy School and a visiting professor at the Harvard Law School. In 2006, he retired as chairman and CEO of the National Association of Securities Dealers, which is the self-regulator of the securities industry in the United States. Previously, he had served as Undersecretary of the Treasury during the period from 1989 to 1992, when he helped guide the nation through the savings and loan crisis. And before that, had served for more than 2 decades as a professor at the Harvard Business School. Diana Enriquez will be joining us. She is a financial investigative reporter who has covered business, governance, and regulatory issues for the New York Times since 1989. She was recently a finalist for the 2005 Pulitzer Prize in Investigative Reporting, where she published a series of articles exposing the deceptive practices used to sell unsuitable insurance and mutual funds and other financial products to young military personnel. These stories prompted a series of investigations that ultimately led to cash refunds for thousands of service members, changes in federal law and state law, and in the Pentagon. So if you believe the only way that you can influence government policy is to be in government positions, here we have Diana.
Welcome. Perfect time.
I was just telling them how you, Diana, have had a marvelous influence in the course of public policy and shaping it from the outside. Well, those are the only introductions that I'm going to give. We'll turn first to Jeff. He will be followed by Ed, then Diana, and then Bob, and then we'll open it up for your questions. Jeff Frankel.
Thank you, Roger. I'll be the first on the panel, but probably not the last, to say that this is indeed the worst financial crisis that we're currently facing since the Great Depression. I will, time is short, I will only spend a minute or two on how we got here, and I'll try to spend most of my time on how I see the last 2 weeks, maybe a recap of what's happened in the last 2 weeks at a slightly greater level of detail than Roger just gave you, and where I think we're going to go from here. The financial crisis started a little over a year ago. It originally was known as the subprime mortgage crisis. Maybe it'll still eternally be known as that, even though it's spread much wider. But it originated with mortgages that were subprime, that were loans that had been made to homeowners on terms that were not standard. We're not where you didn't have the standard down payment. The extreme cases are the famous ninja loans: no income, no jobs, no assets. Some people who shouldn't have been borrowing the money at all, and some banks who shouldn't have been lending it to them at all. I should say that this is, I was just talking about this with Ed, we read so much that everyone got it wrong. The borrowers, the lenders, the regulators, but our recollection is that there were plenty of economists saying that this was a real problem. It was very hard to do anything about it. I think it's a little too simple to say that the problem was deregulation. It might be a little closer to say the problem is that there were some new areas that where regulation needed to be extended. But main point is that it would have to have been the right kind of regulation. Very tricky to do. We're talking about investment banks and certainly hedge funds, how to regulate those in a way analogous to the way we already regulate commercial banks. Very difficult. Something that I think is pretty obvious is certainly predatory lending practices should not have been allowed. But beyond that, I think that our whole system pushed much too strongly in the direction of trying to get every single American possible to own their house. Both political parties equally guilty of this, and it's impossible to argue against because it's the American way. And you sound elitist if you say, well, some people just don't have the resources for a house, but it's true, and you're not doing them any favors by making them loans which they can't possibly pay back unless housing prices continue to go up sharply. And that's the issue. And Ed is a housing expert, and he'll hopefully talk about this. But there was no way housing prices were going to continue to go up year after year. By 2004, I think it was pretty clearly a bubble, perhaps aided and abetted by easy monetary policy. I think quite likely, and there is perhaps some Monday morning quarterbacking that's appropriate there. There's also a much more general problem. It's not just mortgages. It was household debt in general, credit card debt, and other kinds of debt, and we may still see some problems there, and corporate debt, and especially government debt. I mean, the whole country was really up to its eyeballs in debt, and I think that this would have likely caused problems and perhaps made us vulnerable to recession, even if there had never been a crisis. I do want to say that even though some of this seemed to be foreseeable, the problems that would happen when housing prices slow down, what that would create for many of the home buyers, and that might cause a recession. Nobody foresaw that this would spread so far beyond the mortgage market, that you'd have this freezing up of liquidity or drying up, depending on your preferred metaphor, that would affect the most deep, liquid, reliable financial markets in the world, U.S. interbank markets and reaching so far. Consequences, I think recession is already baked in the cake. We're probably in a recession now, if not, we probably soon will be. In fact, it's quite remarkable that GDP has been positive in the first and second quarter because every other indicator has been negative, employment and personal income and all the leading indicators, everything's been negative. And with the last 2 weeks' developments, I think it's pretty clear. You never know for sure, but it's very likely we'll go into recession. What we're really trying to do is, I won't say prevent the Great Depression, I think that's pretty unlikely, but the worst case that we're trying to prevent is a repeat of Japan in the 1990s, where they didn't take care of the problem early enough, they kept papering it over, and the result was a full decade of complete stagnation in growth. All right, let me go to where the action is go from millions of houses to the 2 houses of Congress, which is where the action is this week. First to say that a lot of alternatives have already been tried. I mean, the Fed, great easing of monetary policy, extraordinary new kinds of liquidity operations, and Ben Bernanke's reference goes back to the Depression, and so I think we're sort of fortunate that he wasn't too hung up on operating the way the Fed has usually operated. But we did that, hasn't solved the problem. Bailing out institutions one at a time, we've done that. Hasn't solved the problem. Bear Stearns, Fannie Mae, Freddie Mac, Merrill Lynch, AIG, so on. I think that Secretary Paulson was correct to conclude 2 weeks ago that something more drastic and big had to be done. What he came out with, called the TARP, the Troubled Asset Relief Program, on September 22nd. I think the magnitude, $700 billion, is a huge number, but of course, that's not, I mean, one thing we have to say over and over again, it's not going to cost the taxpayer that full amount, even cumulatively. In past quote, bailouts, like the saving and loan crisis that Bob Glauber worked on, and certainly the Mexican bailout, we made a profit on that, and Chrysler, which nobody remembers, made a good profit on that. Chrysler, we made a profit on, although I wouldn't have supported that bailout, but there are provisions. The September 22nd bill didn't really have any taxpayer protection, and so I thought that was a very serious flaw, was one reason I was opposed to it. Another one was there was no oversight whatsoever from Congress or anyone else. these things were fixed in the bill that they came out with. It grew from 3 pages to 110 pages, and now we're up, this week we're up to, as of yesterday, we're up to 450 pages. But the version a week ago, the 110-page version, had a lot of good things in it, a lot of improvements, and there were a lot of suggestions that people had made that were not in it. So I actually thought it was a pretty good week spent by the congressional leadership of both parties working things out. What it had in it was full allowance for oversight. It had taxpayer protection. I hope this is serious, in the form of warrants. What we need is to get capital. A lot of critiques run like this. We need to get the capitalization of the banks up. And better to do that by increasing their equity than by decreasing the loans, because the original Treasury proposal had socializing the losses and not having any protection or upside potential benefit to the taxpayer by sharing equity. I would like to see more equity participation, but at least the warrants, which are in there, is some allowance for that. And then there's this provision that if that doesn't do it, if the Treasury uses the whole $700 billion, they use it to acquire bad loans, they sell off the loans, they obviously don't recoup the full value. Maybe they get something through with the warrants, I hope so, if the situation improves, equity participation on the upside. And then there's this provision that if the taxpayer is still on the red, 5 years from now, the president has to submit legislation saying how we're going to make it up. Do something to extract the revenue from the financial sector. And one of the things that's been talked about is the Securities Transactions Tax. And Bob will tell you why he thinks this is a terrible idea. But if this bill doesn't go through tomorrow in the House, my proposal is we don't wait 5 years, but we put in a very small security transactions tax right now, because it wouldn't do much harm. It would raise a lot of revenue, which we really need, and it would satisfy this anger, this furor that the American public feels at Wall Street, and that is keeping this bill from passing now. Have I used up all my time, or another minute or two?
Yes, you have.
Okay. Well, I'll have more time in question and answer.
But we're going to have an opportunity for other questions, and thank you very much.
My prediction is probably the bill will pass the Senate. So the Senate voted it last night. It's now going to go to the House. Probably it'll pass the House. If not, then they're close enough together that within a few days we'll probably get a bill, which will help.
So by the end of this week or early next week, your prediction is that we will have a bill?
I think so. I'd be curious what the others have to say,
Okay.
but that's what I think.
Good. Ed.
Thank you. I am, as Roger suggested, I'm a specialist in cities and housing. I'm not a financial economist, and I'm going to restrict most of my comments to the housing markets and how they interact with this current crisis. I think, as Jeff suggested, the roots of this crisis are that large swaths of the large swaths of the financial sector bet very heavily on housing. They may not have known that they were betting very heavily on housing. The tranching of mortgage-backed securities managed to let many of them live in a deluded world where they thought that they were, not at all exposed to the vicissitudes of the San Jose housing market or the Atlanta housing market, but in fact, they were betting very heavily on what was going to happen to housing prices in Phoenix and Las Vegas and Miami. Now, the bad part, of course, is that this betting heavily on the housing market interacted with a doozy of a housing cycle. We've been having, of course, housing cycles as far back as we have measurement of housing prices, but this one was something else, right? So Los Angeles, 2001 to 2006, increases by roughly 150%. Okay? Same basic number is true in Miami. That is a huge number over a 5-year period. The subsequent decline, of course, of those two markets is also quite dramatic as well. The Case-Shiller numbers on Los Angeles are that they gave back, more than half of what they took in over that 5-year period. If anything, the decline in Miami is even steeper. Right? Those are huge swings, and those financial entities that were exposed to that have taken quite serious losses as a result, and we are working through the implications of that for the financial system. Now, let me say a few words about what we think we know about housing cycles and how this came about, and what to expect about prices in the long run, and also what to think about reform in the housing sector. In the long run, economists think that they have a pretty good handle on what drives housing prices. Unsurprisingly, we're thrown back on the twin scissors of supply and demand. And in the long run, housing prices do pretty well when analyzed with supply and demand. If you want to understand which sectors, which areas in the US economy are more expensive, you don't really need to look much farther than the productivity of the area, income, wages, and the amenities. January temperature is a pretty good proxy for amenities. And it's true that, at a point in time, you can explain more than one half of the variation in housing prices across metropolitan areas just by using median income and January temperature alone. That those two things do a remarkably good job of explaining these things. Of course, at the micro level, things like school districts and other amenities also matter. Supply, however, is the other side of the story, and supply is going to be a big part of the story that I'm going to try and tell about this cycle and what to expect going forward. You want to think about housing supply, and housing supply is not the number of houses that are being sold at a particular time. Housing supply is really the number of units that have been built in an area, and the growth in supply is the number of new units that are being brought to market. You want to think about America as being divided not in two Americas, but in three. And there's one type of America which is on the coasts. It's an expensive America, it's often a very economically successful America, and it's an America where it is awfully difficult to build. And it's difficult to build partially because of lack of land, but also, far more importantly, because of land use regulations that make development almost impossible. This is the world that we've lived in Boston for the past 30 years. It's the world of Manhattan. It's the world of coastal California, where Marin County manages to enjoy 60-acre minimum lot sizes in some of the areas, okay? So in these places, supply is essentially completely restricted, and this is going to be important for thinking about how housing cycles play their way out. There's a second America, which also has relatively constant housing supply, but it has constant supply because demand isn't high enough to justify unsubsidized housing construction. These places have names like inner city Buffalo, inner city Detroit, lots of old Rust Belt cities where housing was built at a time that these areas were more productive, and they're less so now. These areas are not ones that we need to pay much attention to for the purposes of this crisis, because in fact they're not a huge fraction of America's housing supply by dollars, and they haven't been a large fraction of what's going on. The only interesting city on that is Detroit, which has actually had, it's the one place that did not have a large run-up, 2001, 2006, and has still managed to get in itself a substantial decline since 2006. But I promised to stop picking on Detroit for the new year, so I'm not going to do it. And then, of course, there's the third America. There's the great open spaces between those coasts. There's Houston, there's Dallas, there's Phoenix, there's Las Vegas, there's Atlanta. The four fastest growing metropolitan areas in this country are, of course, Atlanta, Dallas, Houston, and Phoenix, building hundreds and hundreds of thousands of new units. And in those areas, supply is essentially unrestricted. They don't have, in unincorporated Las Vegas, they don't have rules that prevent new construction that are particularly severe. They've got plenty of labor force, and prices, until the past crisis, hewed enormously closely to construction costs. Okay? You can build forever at $80 a square foot, plus some moderate price per land, plus some moderate builders thing. How in the heck are long-run prices going to diverge away from those supply costs? You just build more. And some of us watched with amazement during the years 2004, 2005, when Las Vegas, after 20 years, when we've had observable data, actually 50 years when we've had observable data, hewed so closely to construction costs, all of a sudden Las Vegas took off. That certainly looked unsustainable. Now, while long-run prices are easily understandable through the lens of supply and demand, housing cycles are much harder to understand. There's a certain extent to which short-run economic fluctuations can explain some, I would think no more than a quarter of local housing price cycles. There's a certain extent to which credit can explain things. Lower interest rates has a small effect. Certainly the push of credit availability towards lower income and towards a wider swath of Americans played some role in this. And like Jeff, I also blame both irresponsible lenders and also government policy, which further this. But the truth of the matter is we can explain very little of the huge cycles that actually occur in housing prices. They call it animal spirits or irrational exuberance or irrational pessimism if you want, but we have not yet been able to explain that. We do have three facts, though, that have established themselves. Fact number one is momentum. At one-year frequencies, prices move the same way they did last year. If you're in the midst of a boom, if it's going up, it in general goes up next period. Over 5-year frequencies, we've got really strong mean reversion, and these are not marginal results. Over the past 25 years, every dollar you go up as a metropolitan area relative to national trend and relative to the metropolitan area average, you give back 32 cents of that over the $5 over the 5 years that come subsequently. It's completely predictable. There's an enormous R-squared of this, enormous ability of the past to predict the future in this. Places with booms have busts. And the third fact is that the cycles historically have looked completely different between the constrained areas on the coast and the unconstrained areas in the center. If you go back to the last big housing cycle, 88 to 92, right? All the price variation was in constrained places, places with little land, places with restricted housing supplies. Las Vegas, Phoenix, Atlanta, those prices are just flat. It's not that they're sitting out the housing cycle. They have huge construction booms during this time period, but all the added demand is showing up in new supply. It's not showing up in quantities. Now, how do we understand what's going on right now? So over the past 2 years, we've seen the top 20 markets give back 50% on average of what they took in over 2001 to 2006. So we've seen a huge amount of mean reversion already according to the Case-Shiller data, much less according to National Association of Realtors data, and there are reasons for that. But we've already seen huge mean reversion. Does this mean we're anywhere close to the bottom? I don't think so. But although my confidence is much greater when talking about places that are unrestricted in land than places that are restricted. One reason to think that we're not close to the bottom is just this momentum fact works on the downside as well as the upside. A good year means a good year next period. A bad year means you expect more to come in the next year. So that's one reason to expect this to continue to falter. The second thing is we're still nowhere near construction costs in Las Vegas or Phoenix. Atlanta, Houston, Dallas, these places look fine. These places, in fact, didn't have huge gains. But Miami, Phoenix, Las Vegas, still a wide divergence from this. And I think we should and can expect more to come on this. And that certainly means that valuing these securities that Secretary Paulson is eager to buy is going to continue to be quite hard. And it means that the people who are still long real estate are probably going to continue to lose. Now, I want to end with one. I'm actually not going to push. Maybe I'll say something at the end about the actual proposal on the table. But I want to actually push back on a proposal that has been floating around. You might think that in fact, because housing prices lie at the root of this, the right answer is to somehow or other stabilize or keep up or boost housing prices. I think this would be a terrible mistake for 3 reasons. First of all, for every person who owns a house, there's a person who's short housing, right? We come into this world short housing, and in general, right, you need to own a house. In general, rising housing prices are not great things. It means we've created affordability problems for more and more people. The decline in housing prices is not, it's a terrible thing, what it's doing to the financial sector, for making Boston more affordable, more accessible, a more, a better balanced metropolitan area. I'm cheering that prices are declining. I've been cheering for this for 8 years in the hope that this would happen. The last thing we want is some artificial policy to go in and change credit conditions and try and make housing less affordable, less accessible, to make it harder for middle-income people to buy houses. We don't want to boost them anymore, certainly, but we certainly don't want to work against it. Second point is the tools that are on the table are actually too weak to do it. There's all the messing around that you're going to do with credit rates or interest rates or whatever is not going to keep the price of Las Vegas housing above the supply costs. You just can't do it, okay? And in fact, the people who think that the interest rate elasticity of housing prices are very high, I think are missing the longer time series, which suggests there certainly is a connection. Lower interest rates boost housing prices, but it's small. And you have no ability to make up a 50% decline in housing prices by pushing interest rates down a little bit. I mean, you just don't have the tools there. And the third point is that most of the housing plans that are put on are also staggeringly wasteful, right? Just involve staggering amounts of buying up securities or lending money to people. So I think while housing markets fall at the ultimate root of this, you really don't want policies that are going to mess up housing prices or undo this in some way of saving the financial system. Let's save the financial system by saving the financial system. Let's not screw up housing prices by doing it.
Thank you very much. Diana.
I know we're going to have interaction later, but it'll be interesting to see what gas prices do to that supply constraint notion when it's a 2-hour commute from the cheap housing to downtown Las Vegas, and that's going to cost more than you're going to make when you get to work. That might effectively be a commodity-driven constraint. I will be very brief because I don't have any prescriptions for what to do. I do have some observations, though, from the foot soldier level about some of the root causes. 3 observations. One of them is that I think part of the root cause of the housing bubble and the attractiveness of housing is a sort of pervasive social insecurity. Americans have not come close to saving enough for retirement, and all of them know and believed that their retirement account was what? The equity in their home. That's what they expected to retire on, and so they didn't worry too much about saving to actually retire. So the notion that everybody had to have a house wasn't just that everybody had to have a house, it was that everybody had to save for retirement. And this was the only and easiest social way that we had found to provide that retirement safety net. So the sense of social insecurity that arises from the demise of defined benefit pensions, from the insecurity about health care costs, the whole notion that you can't save on what you're making when you haven't even seen real gains in wages over a period of time. How do you save for retirement? You buy a house. That's what millions of people did. So let's not pretend like people just wanted to flip or wanted to play a bubble. They knew they needed money to retire on, and this was a way to get it. So take the social insecurity of that retirement prospect. Add to that the almost perfect poetic justice of Wall Street figuring out that Main Street could suffer and it wouldn't feel the pain. Now, of course, today, Wall Street is trying to persuade Main Street that when Wall Street is suffering, Main Street will feel the pain. But back when the pain on Main Street was predatory lending and abusive lending practices written up in every newspaper in America, you can go back 15 years and find huge exposés, repetitive exposés. I've judged many of them in press contests over the years, just change the date line. But the notion was that, and this was a decision made more or less rationally by our senior banking regulators, was that if you were ripping off Main Street with predatory loans, and the profits on those loans were high, let me see, if my primary concern as a regulator is the safety and soundness of the institution making the loan, why would I care if that institution is making piratical profits on those loans at the expense of Main Street? I wouldn't really care, and in fact, the Fed didn't really care. And for years did nothing in spite of, I can count at least 4 congressional hearings over that 15-year period that dealt with predatory lending and its excesses and its impact on little people on Main Street, and nothing was done because no one realized that through the unappreciated marvels of financial engineering, every one of those crappy predatory loans was going to be sliced and diced into a million pieces and tucked into something that Wall Street would buy after it sold it. So that disconnect between Wall Street and Main Street, that sense that Wall Street could prosper by ripping off Main Street, or that Wall Street could prosper even though Main Street was being ripped off, I think was another one of the roots here. And as I say, it's so perfectly poetic that now that Wall Street is trying to say that that Main Street's survival depends on easing Wall Street's pain. I think they're right, but the poetic justice is not lost on me. And then finally, I think one of the more near-term reasons that we got here and that we got to such an intractable political problem, such a knotty political mess, is because in a large extent, and I think the financial media is as culpable here as anybody, we didn't teach America how to think about the credit markets. We didn't even teach America that there were credit markets. We have an American public that is completely fixated on stock markets. Dow goes up, Dow goes down. Some of them even discovered the S&P 500. That goes up, that goes down. But none of them have discovered the Treasury market. None of them have discovered the LIBOR market, the interbank loan market, even the currency market. So the failure on the part of leaders and supposed communicators, the sort of media educators that I like to think of myself as being among, that we failed to educate policymakers and people, Main Street, about the importance of these credit markets. Big, important, terribly boring. You know, the chart of a Treasury bill change is like little infinitesimal molecules on the top of this huge ocean, and it doesn't make as dramatic a fever chart on the TV screen as the Dow does. So, you know, we're left then with legislators getting phone calls from people who had never heard of LIBOR and didn't understand what it going completely kerplooey would mean to them. So I think it was a failure of education, not just on the part of the media, but also on the part of political leaders and people who ought to have understood that they needed to educate that on that topic. I mean, it was interesting that the credit markets have been in turmoil, near constipatory turmoil since last August. How many of you knew that? How many of you knew that last November there were almost 24 money market funds whose parent companies had to bail them out because they owned a bunch of crap in the money market fund that suddenly in the credit market crisis couldn't be valued? Anybody know that? No. And the reason you didn't is that we didn't make a big deal out of it, and we probably should have. So I think if there is any prescription I can offer going forward, it would be to improve the quality of communication about this critically important piece of the financial plumbing that America should know as well as it understands NASDAQ, but that it doesn't, and therefore did not understand the crisis that we're in and the crisis that has been brewing until it was really almost too late. It may even still be too late. So those are my few observations about how we got here and that one possible prescription that we can do the communication part a lot better, I think.
Thank you. Bob?
Well, I myself, apropos what Diana just said, am looking forward to both LIBOR and the TED spread becoming household words. And she's, of course, quite right. They should be. Coming last, Roger asked me to stay alert and listen to what other people said and try and fill in some gaps that might have emerged. There aren't many, because I think people spoke very, very wisely, not at all surprisingly. But let me do a few of these things and just hop from point to point. In terms of the problem and the credit market losses, let me just size the issue for you a little bit. Estimates are all over the place and they change. They've generally gotten worse, as you could imagine, as we've gone through this financial crisis. But sort of middle of the road estimates now in terms of the total amount of losses out there are on the order of $1.1 trillion. This is a meaningful number. I was part of the attempt to fix up the S&L mess. Those numbers in today's world numbers would be 350 to 400. So this is a seriously greater, as Jeff said, this is, you got to go way back to the Depression to see anything like this. In terms of where the losses are, about 50% in banks and investment banks, and the other 50% spread pretty evenly among insurance companies, pension funds, the government, Fannie and Freddie, and hedge funds. In terms of instruments, about 60% in residential mortgages, but as a couple of people have said, it's not the only problem. Another 20% is going to be in commercial real estate probably, 10% in consumer credit, and 10% in corporate credit. So that sort of sizes the problem. In terms of its effect on the real economy and how much worse it's gotten because of this financial crisis, just a couple of things. Probably by these estimates, and these come from the economist Moody's, next year's real GDP growth will be probably 0.6% less than it might otherwise be, which is a meaningful number. Peak unemployment, instead of being at 6.5%, may be well over 7.3% is their estimate. And housing prices, as Ed has talked about, used to be that the peak to trough broad estimate was 25, 26, 27. It's probably now 30. 30% housing price decline nationwide is a real number. We haven't seen anything like that. Well, Ed will know this better than I, but we haven't seen anything like that since the Depression. And this will only take 2 years, this decline. The Depression, it took 4 or 5 years to do that much. So this is serious stuff. In terms of sort of why it happened, I guess I should go back. In terms of this sort of freezing up of the markets that everybody's talking about, to use the terms Diana was talking about, LIBOR. LIBOR is a lending rate between banks. Banks trust each other. They may not trust you, but they're supposed to trust each other. The reference number on this right now is the Fed funds rate, which is 2%. On Tuesday, LIBOR, overnight LIBOR was 6.88%. That is appreciably larger than 2%. That is a measure of just how tight things have gotten. Nobody.
Which is normally like
Yeah,
10 basis
yeah. I
10
mean,
basis
it is.
points, right.
It's the molecules that Diana was talking about.
But
sort
think
of.
about what this means. This means that there are banks that are not willing to trust another bank until tomorrow morning,
Yeah, this is overnight. This isn't
unless they
long-term.
get 6% for their money.
Yeah.
I mean, that's like loan sharks. But anyway.
Well, and then they aren't lending. I mean, it's just that simple.
It's
It's
that
my
and don't
money,
get the
and
money.
I ain't giving it to you. So that's a measure of just how tight this has gotten. And when we talk about freezing up of the market, that's freezing up. In terms of what caused all this, the credit bubble, I would say that it was a period at the beginning of this decade of artificially low interest rates and high liquidity. Nobody wanted to live with 1% rates that you get on safe things. So investors were lured into slightly less safe. Don't worry about it. It's really, really safe. Not quite as safe, and it yields more than 1%. Once investors wanted that, the investment banks were only too happy to manufacture instruments to give them that. Only a little bit riskier, but a good deal more return. And what they used to manufacture it was mortgages. Big supply of mortgages, $10, $11 trillion worth of mortgages, and they manufactured these weird instruments you've heard about out of those. I would say, following what Ed said, that a lot of this bubble can be traced to increased demand for this, simply because the manufacturer of these instruments made mortgages in demand. People wanted to have mortgages to sell on to investors, and so mortgage terms got very, very loose, and we had a bubble. Again, this is stuff Ed knows better than I do, but my understanding is that home ownership, which we clearly want to encourage, runs around 64, 65%. It creeps up a little bit each year. We got up to 69% a year, 2 years ago. This is sort of an artificial bump, and we're getting back down again now, I think. The freeze up, what caused that? I mean, basically, markets lost confidence in each other. Banks wouldn't lend to the people they lend to every day. They panicked. Why did they? They don't know who owns these toxic instruments. They don't know how much they're worth. If they don't understand that, if they don't know it, they say, I'm just going to sit on my own money, and I'm not going to lend it. They're worried about the people that they would lend it to, and that isn't you. That's Bank of America lending to J.P. Morgan. They're worried they won't get paid back the next day. Sophisticated investors simply didn't trust the numbers that other banks were publishing, and maybe they shouldn't have. At the end of the second quarter, Wachovia, which is no more, published its financial statements. It said it had $75 billion of net worth. 4 or 5 days ago, Wachovia was sold for $2 billion. Now, that was a panic sale, and you can say it was probably a tenth of what it should have been. So it should have been 20. But Wachovia was sold for 20 when it said 2 months before that it had $75 billion of net worth. It's easy to see why these numbers aren't trusted. Will TARP, as we now call it, work? Well, what's it supposed to do? It's supposed to deal with the loss of confidence. It's not supposed to deal with home prices. It's not supposed to deal with mortgages. It's not supposed to even stop the losses. It's supposed to unfreeze the markets. It's supposed to deal with the confidence, or lack of it, that has sophisticated investors unwilling to make loans to each other. It seeks to do that by establishing prices for these complex securities and lifting them off of the balance sheets of these banks that don't want to own them, so that they can, in fact, own other productive loans. That's its purpose. I think that is the right purpose, because I think as long as there are no realistic prices set for these instruments, and they sit on institutions' balance sheets that don't want to own them and haven't fully recognized the losses from owning them, lending system will just freeze up. And this isn't hypothetical thinking or forecast. This happened in Japan, as a couple of people have said, during the 90s. These kinds of big loss toxic instruments just sat there. The government wouldn't do anything about them, and Japan had 10 years of stagnation because the banks wouldn't make productive loans to businesses and people who needed those loans. My bet is that if you understand what TARP is meant to do, It will do this. It will unfreeze the system. It will establish realistic prices, and it will lift these unwanted assets off the balance sheets of the lending institutions that they are clogging up right now. And frankly, if it succeeds in doing that and gets lending started so that banks will lend to companies and they can pay their payrolls and they can continue to employ people, so if banks will lend to people who want to buy homes and let them get a mortgage, I think that will have a profound effect on the real economy. It will prevent it from getting much worse than it would if we don't do this. So while it is popular to talk about this as a bailout of Wall Street, in some sense, very meaningfully, it is as much a rescue of individual normal people like all of you and me, as much as it is a rescue of Wall Street. What else needs to be done? Lots of things. Again, I think both Jeff and Ed talked about the need for capital in the system. That won't start happening again until the banks relieve themselves of this toxic stuff that is cruddying up their balance sheets, and then investors will put capital in because the banks can then start making productive loans. And that will happen. Whether there's enough capital in the private sector to recapitalize the banks, all they need, is a very interesting question. The Fed can do a lot to make it easier for commercial investors to put money into the banking system, and I personally hope they will. We can talk about changes in regulation. Clearly, all kinds of changes are going to be needed in regulation. We're going to go through a period of serious increase in regulation, and I think we should, because the fundamental question is, and I hope it will be the question that we use as we consider alternative new regulations, so what is needed to supplement the ability of markets to discipline themselves? What we've learned from this experience is that markets don't do a perfect job at disciplining themselves. That is a somewhat understatement. But the right way, I think, to measure new regulation is to say, is this useful in enhancing the ability of markets to discipline? And sometimes regulators have to intervene. That, I think, is going to be the quest going forward and will be a very interesting debate.
Thank you very much. Well, one of the happy traditions at the forum in the Kennedy School is the opportunity for the audience to participate in the discussion by asking questions. And we have now come to that point when this is your opportunity to participate in posing questions to our panel. We ask for three things. One, that all questioners identify themselves. Two, that they offer one brief question, that is, no speeches and no supplemental questions. And three, that your question end with a question mark. We have 4 microphones, 2 here and 2 upstairs. We're going to go first to the young lady in green at this microphone and give you the opportunity to ask the first question.
Great, thank you for being here. I'm Sarah Hinkvist. I'm a junior at the college. And I'm interested in the relationship between the mortgage, the household, and the government. So on one hand, we have the social arguments about predatory lending and people needing a home and a mortgage to support the home for retirement. But on the other hand, we know that mortgages that are going and houses that are going under foreclosure are important to bringing house prices back down to where they need to be. So to what extent do you think it's appropriate at all, and if any, for the government, either the national level or states, to fill in if they need to provide loans to homeowners to pay for mortgages?
Let me just start by offering the thought that there is nothing wrong with renting. I mean, lots of people rent. It's a perfectly happy experience, you know. And housing is not the only way to save. We have very well-developed financial markets. There's mutual funds. There's 401ks, which are tax advantaged. And you could go through life perfectly well never owning your house. I mean, you know, so let's not overdo that.
You know, I agree with that quite strongly. I think that the majority of government policies that have been aimed at artificially boosting the home ownership rate have actually probably been fairly deleterious. And we've observed some of them, you know, Fannie Mae and Freddie Mac being 2 of the big interventions. And I'm not claiming that everything that Fannie and Freddie did was terrible, but they certainly were, you know, a giant risk waiting to happen. the home mortgage interest deduction is very problematic. It's actually very poorly targeted at increasing home ownership, but very well targeted at inducing rich people to spend more on housing, which does wonders to keep housing prices artificially high. Even if you believed that there were huge social benefits from having people become homeowners, I've written on this topic, and if you actually do believe that they do vote more and get involved in solving local problems, they garden more, they own more guns, maybe that's a good thing. Even if you thought that somehow or other this was such a great thing, most of the policies that we have in place are not particularly well targeted to do that. Certainly the home mortgage interest deduction is a disaster because it's not targeted to guys on the margin. I just want to end on one, there's this great irony that for the 20 years that I've been involved in thinking about this, the whole focus of public policy concern is why is it that poorer people can't get mortgages with greater facility? Why isn't it that we haven't made mortgages available for people who can't afford down payments or don't have good income records? And that is a huge public policy disaster that we have to do something about. Now, apparently the subprime guys did something about it, and it didn't work out very well. So, it is, I think it is a cautionary tale about thinking that the government should be too involved in this. And I agree with Jeff. A lot to be said for renting.
Great. Okay, we'll come to the young lady here. Thank you.
Hello. My name is Kimberly Spector. I'm a master's candidate at the Graduate School of Education. My family's in real estate on the coast of California. I get most of my information from the mainstream media, and it's making me feel hopeless. And I'm wondering how you would rate the way that the American media is handling our situation, how accurate they are, and how hopeless we actually are.
Okay.
All of us about this.
Diana,
Why did everyone turn and look at me?
We certainly have an expert on the panel able to address that question.
Oh, me. How would I rate the media? Now, it's interesting that you said that you felt hopeless from reading the media. I sometimes do too, but I don't blame that on the media. I sort of blame that on the policies that have been pursued that have produced the news that we have to write about. I'd much rather write about something else. As I said before, I think the media in general has been less effective in its educational mission with respect to most important markets, some of the most important markets in the country. We haven't educated people very well about. But in terms of the root causes, and the sort of ancillary symptoms of this particular crisis, I think our conscience is clean. It would be hard to find a run-up to a disaster that was better covered than this one. But we warned, there were stories, national mainstream media stories on the increase in consumer debt. There were national mainstream stories on the dangers of financial engineering. There were mainstream stories on the incredible levels of derivatives, swaps, credit default obligations that were poorly understood, whose risks and ramifications were poorly regulated. And there were countless stories about all of that. But we just get to write them. We don't get to impose the corrective policies. So there are many issues about which I think you can fairly take the mainstream media to task for perhaps having fallen into a false equivalency. There are two people yelling over here on this side about global warming, and there's 2 million people over here with good evidence, solid evidence about global warming, and we're saying on the one hand and on the other hand. But that isn't what's going on here. I think we did cover the attendant problems. To the extent that we failed, I think it was a failure to connect the dots and to avoid topic fatigue. And when you've written your 4th story about predatory lending over 8 years, it's hard to sell the 5th one to an editor, even though people are still doing predatory lending. So at some point, you go to the regulators and say, I read this in the paper. Why didn't you stop it?
I mean, I think Diana is right, certainly on the last point she made about predatory lending. I mean, the record there is terrible. Not the record of the media, but the record of regulators. Partly because that market is regulated generally, not nationally, but by the states. And it just hasn't been regulated properly. It will be. I think one of the benefits coming out of this is clearly we're going to have better regulation of lending practices because they've been basically disgraceful.
Ed?
Just on the bleakness of the hour, yes, it's probably true that California prices will continue to decline slightly. But as we've been through a lot of these cycles, and California does come roaring back after a while, and it's hard to keep a generally dynamic economy and splendid Mediterranean climate down. So just hold on to your house. Don't buy as a short-term investment, and in the long run, you'll still have a valuable asset. That's the.
Yeah. Thank you for your question. We'll go up to the gentleman and.
Well, I'm so sorry to be up here, but to all of you, I'm sorry you're having trouble seeing me in the lights and all. My name is Vic Brungart, and after I got my MBA from Pennsylvania State University, and I'm sorry it wasn't Harvard, but I was on the career track to be the chief executive officer of a little oil company by the name of Exxon. And we did a good job, I thought, and I think we're still continuing to do a good job in spite of what people think of us. I also then went to Wall Street with a little bank called Citibank. And the point that I'm going to ask, because I'm a Southerner and I like to make it short and sweet, I heard a lot of people talk about derivatives. And having had a little MBA in finance, I decided that I'd think about derivatives. And I said, this sounds like a pig with lipstick on it. Now, I don't know what you people think, but I think the Community Reinvestment Act was fostered upon some people. And I think the overuse of derivatives has contributed to where we are today. The question I have to all of you folks is, given everything that we have, how really, in 20 words or less, are we going to get out of this? Because certainly Congress is at a total impasse right now. Am I incorrect?
I guess I wouldn't be as pessimistic as you are. I think Congress will actually pass this thing. We've gone through the process that you have to go through to get legislators to pass. Look, step back. First of all, this has got to be the worst time to ask legislators to make a difficult vote. I mean, it's 5 weeks before the election. And they're going through it because they're all pros, the process that you need to go through to get the legislators to make it easier. They're going to beat up on Wall Street some, so you can say that. Increase the deposit insurance, which a lot of people, it worries them, but it's good. We have done away with the excise tax on wooden arrows, 39-cent excise tax on wooden arrows, because somebody needs that to vote for it. They only need 15 votes, and they're going to get it. This is going to get passed, and I believe that once it's passed and the Treasury goes through the process of implementing this TARP, it really is going to do a lot to remove this congestion, this freezing up, this loss of confidence in the debt markets. And so I'm not nearly as pessimistic as you are.
Okay.
I didn't understand the connection between CRA, Community Reinvestment Act, and derivatives.
May I just make that connection
Sure.
for you? In 3 words, too much government.
Well, I don't know.
I still don't
I'm trying
understand.
to get the impression. I think a lot of people think we might have had just a little bit not enough government, or at least not enough smart government with respect to certainly mortgage market practices and abuses, derivative practices and transparency. I mean, I could go on about instances that contributed to this crisis that were the consequence of either stupid government or not enough regulation. So, I mean, we could certainly have that discussion. However, I believe I've seen data, you guys would know better than I, that the CRA communities were very underrepresented in the loan pool that contributed to this mortgage mess.
Apparently, so CRA is the regulation that strongly encourages, or more than encourages, sort of forces banks to lend in poor communities. And my information is the same as Diana, that they, although it's part of this effort to make sure that everyone, no matter who you are, can buy a house, that actually it was better designed in the sense that, it wasn't one of these where they want to make you buy a house whether it's in your interest or not. They actually did take some steps to make sure that people were creditworthy and that it actually has held up pretty well. So CRA is not that bad. On the other hand, the derivatives, I don't even understand. I mean, most people who are hot and bothered about derivatives think we need more government regulation. So that leap I didn't understand at all. Derivatives in some area, I'll defend them completely. Some people think derivatives were to blame for the big increase in oil prices and other commodity prices over the last 5 years. I think that's wrong. I'll defend derivatives when they have a good economic purpose. I'm not convinced that derivatives written on these bundled and sliced and diced mortgages, such as the credit default swaps and all that, have a good purpose. Bob's convinced me that we shouldn't ban them completely, just raise capital requirements on the institutions. But I think there are some derivatives that don't deserve to exist. Hopefully they'll die out now on their own.
We'll
Thank
go up
you,
to,
all of you.
thank you. We'll go up to the questioner in the far right.
Reg McKean of the Harvard Institute for Learning and Retirement, and I've not heard anything from the panel about an issue that was addressed in a Boston Globe op-ed yesterday by a Harvard political scientist and deputy provost. It's the fact that for years our nation has lived beyond its means by spending 5 to 7% more each year than it's been earning. I would appreciate it if any or all of the panel would address this issue.
Okay.
Well, I did refer to that quickly. I think that is been a very obvious problem that's been there for a long time. You've got this big budget deficit. First got very big in the 80s, came down a bit, but now I think the twin deficits are back. Looking forward, we've got
Budget and trade?
budget deficit and trade deficit, yeah. Your figure sounded like it was the trade deficit, current account deficit, how much we're borrowing per year. And I think it's a huge problem. And it's the biggest of the debt problems, and I think would have left us very vulnerable to a recession even if none of the rest of this had happened.
There's no question that one of the contributors to this is just the long-term trend of increased debt and leverage at all levels, household, business, and government, all of them. I mean, household debt as a percentage of GDP was 68% in 2001. It's 98% in 2007. So why has it happened? I don't know. I mean, I'm sure cultural anthropologists will say one reason is that people now have completely forgotten the Depression. But there are other reasons. Real wages weren't growing as fast as people wanted to consume. And so they borrowed in order to keep their consumption level up. That clearly was a contributor to this bubble and to the collapse that we're now facing.
And we now have 105 billion credit cards.
I'm sorry?
We have 105 billion credit cards in the United States now. So if
50 million.
right. So
That's four
if
for
you
your
look,
dog.
let's take Bob's point looking at how much debt we've got. If you look at individual, corporate, and governmental debt in 1950, it was about 100% of GDP.
Right.
50 years later, it was about 300% of GDP. We had basically said, okay, we're going to take on more debt. Well, you can do that for a while, but as our questioner points out, eventually there is a time when you can't continue to do it indefinitely. We have been, as Jeff pointed out, managing to have the rest of the world do a lot of saving for us and send us money so that we could live beyond it. And we've reached a stage now where we can't count on that happening indefinitely, and we're going to have to change some patterns.
I just wanted to demur slightly here, because the problem isn't that people borrowed money, it's what they did with the money they borrowed. If you are determined to live within your means, you'll never own a house, because the year you buy a house, you spent a heck of a lot more, I guarantee you, than you made that year. but you invested it in something that you thought would not only hold its value, but increase its value. An entrepreneur starting a business, if he's determined to live within his means while he gets that business off and running, he's going to fail. Because you need risk capital,
No one's saying
and
that
that's
should
going to
be
be
zero.
borrowed.
No one's saying you shouldn't borrow at all.
But unfortunately, popular crazes run to extremes. And one of the difficulties of the post-war period was that too many people remembered the Depression. One of the books in my meager output is a history of the original corporate raiders in the immediate post-war World War II period, where, the Tom Evanses of the world who came home from the war, and there were companies that could be bought for less than the amount of money they had in the bank, which was insane. You know, if you could buy a suit in the store and you knew that there was a cash in its pocket worth more than it was going to cost you, you'd buy that suit. But nobody would buy that suit because you'd have to go into debt to buy that suit, and debt was still such an evil word in the business community. Forget on Main Street.
We've gotten over that.
Yeah,
We have managed to get over
But we
our...
went to that extreme, and I fear that we will again. And the cost will be a great deal of, what we will give up is a great deal of potentially productive investment.
I mean, Diane is so correct that it matters what the debt is used for. I mean, if you really borrowed a mortgage to buy a home, and this was going to be what you were going to fund your retirement for, it isn't the only way you can fund your retirement, as Jeff has pointed out. There are mutual funds. The problem was so much of the borrowing that ran up household debt was second mortgage loans, where people lifted off the appreciation of their houses, their homes, not for retirement, but just to continue to consume.
So
we
they
ended
could buy
with-
that $1,800 handbag.
Yeah.
To me, it's the handbag problem. I mean, no, true. My husband won't let me read the fashion ads anymore because I get so exercised about these handbags.
We don't see it as the handbag problem.
I
but
understand.
The
Well,
alligator shoe problem or something.
If you start reading these price tags, you will.
Let's go to our young lady here.
Yeah, thank you for being there. My name is Clément Charat, and I come from France. So I'm here as an exchange student for 1 year. And a lot of European and Asian banks around the world are now facing real troubles as a result of the American crisis. So my question is, beyond the American decisions to heal national economy, what message would you address them? And as the world is looking at you, how much time do you think the world financial market will need to recover? So that's a broader question, but what would you say to them?
I'll let Jeff handle that seriously, but I actually want to use this question to make what's really, I think, a very important point, and it's related to the previous question about foreign debt. In fact, I would argue that the biggest losers from subprime and from the crazy tranching and all this were not actually the people who borrowed. Many of whom took out the full value of the house, used it to buy those handbags that they got so much value at it. And as it turned out, they were in some sense making a gamble on the value of the house. If the house had gone up $200,000 instead of down, they would have made a ton of money. As it was, they were able to walk away from the loan. The losers were the investors, right? The guys, which is not in any sense to minimize the real human suffering of some parts of the subprime loss, but the losers were the investors, and huge numbers of those investors were not U.S. investors. And in some sense, this is a replay of what we saw in the late 80s, where everyone was exercised that Rockefeller Center was being sold off to Japanese investors. One of the greatest deals America ever made. It was selling off at peak prices American real estate during the boom of the late 80s that then got bought back at the trough. In the same way, in some sense, European losses from this investment is making up for some portion of all the trade deficits we've been running over the past couple of years. Now, you have to answer it more seriously.
No, that is true. I mean, we've been sort of doing very well in the United States for decades now. This goes back for 30, 40 years that foreigners keep buying up U.S. assets, and then they keep going down in value, both in terms of local currency and then the dollar going down against foreign currencies. I mean, but beyond that, this is, initially there was all this talk about decoupling a year ago, that this is, for once, this was a crisis that was going to be felt because it was originating in the United States, and because the rest of the world was in a much stronger position. Asia, growing like gangbusters, emerging markets doing well, even Europe doing better. That the effects would not be felt as much abroad, and that's turned out not to be true, at least with respect to Europe. Which is already, much of it is already apparently in recession, and Canada. Emerging markets, many of them are still doing pretty well. Of course, Russia has just been devastated by this, but that together with invading Georgia, I don't feel sorry for them. I mean, it was a combination of the two. They picked the wrong time to invade Georgia.
Are there good times?
Well, not before an American election, not when, no, they could have picked a better time. Commodity prices are back, going back down.
Okay.
Just before you...
Okay.
Sorry, short answer is, we want to know what I say to Europe. Sorry about that.
Well, before Jeff says sorry about that, though, I think it's important to point out that nobody made them buy these instruments. I mean, this was a voluntary transaction, and they've lost, and we've exported some of these losses, but they're adult, sophisticated investors, and they chose to buy them.
Well, and from a historical standpoint, I should point out that, in defiance of the old adage that the definition of insanity is doing the same thing over and over again and expecting a different result, Europe has been buying American speculative paper since about 8 months after the Pilgrims landed here, I think, roughly, give or take. And have been losing. I mean, we've had the Mississippi bubble that devastated France in the 18th century. We've had the American railroad speculators who devastated the city of London in the 19th century. I mean, there's a long history of Europe putting its money to work over here in this booming economy and getting their head handed to them. So at some point, I fear they're going to say, not again, but...
Sir.
Yeah, Evan Hutchison. I'm at the Kennedy School MPA student. And I just want to latch on to what Professor Frankel said about the Securities Transaction Tax and just ask you, I mean, to me, I see a lot of parallels to what was occurring in the 90s with the contagion crises in the emerging markets economies. And everybody's saying that capital control and limiting speculative capital was the worst thing in the world, yet you saw countries with capital controls actually emerge less scathed, India, and I think it was, I forget who at that point, but China and India, right, emerged all right. And I mean, do you think, though, that there's any real, do you think the role of speculative capital in all of this and the free flow of speculative capital had a big impact on what occurred in terms of there being real underlying value, but people just fleeing? And B, do you really think there'll ever be a political will to slow that down, to do kind of a Tobin tax sort of scenario?
So Tobin tax is a famous sort of catchphrase, and I worry when it comes to discussions about international capital controls that just all kinds of very different proposals are thrown together into one big lump. Now, most capital controls, I think, are not useful, and there's a reason why countries have been removing them. And India and China have sort of been the holdouts, but even they are sort of moving in that direction. And it's interesting after the East Asia crisis and the Russia crisis and all that. I mean, Malaysia put some on for a while and got a lot of attention, but basically that's not where the movement is. The long-term trend has been towards liberalization because countries see the benefits of participating in world financial markets as outweighing the downside, which is some vulnerability to periodic crises. The version that I was proposing is a very small tax on the turnover of buying and selling securities, and the Tobin tax was the same thing, but internationally for foreign exchange. Usually when it's proposed, when Tobin originally proposed it, it was to reduce volatility. Well, there's been plenty of experiments with this. Countries have tried transactions taxes. The Tobin tax hasn't been tried because it doesn't work unless everybody tries it at once. Enforcement is a real issue there, even more than in domestic securities taxes. The evidence is really that it doesn't succeed in reducing volatility. I mean, there's one or two studies that say that, but there's one or two studies that says it increases volatility, and basically it doesn't seem to have an effect. But that's okay for me. It doesn't seem to do much damage. And it raises some revenue, and I brought it up in a political context of if this bill doesn't go through, it's because the American public is so furious at Wall Street, and the high salaries that are being earned there, and the fact that we're all being made to pay for it, that we need to do something big that will give substantive vent to that anger. And this would be a way of doing it without, I think, doing much harm.
I mean, in terms of this role of speculative capital, though, as well, do you think it exacerbated the crisis? Or?
I mean, speculation is not a dirty word for me. Speculation, I mean, first off, everything that goes on in financial markets is speculation. You can't have financial markets without speculation. The definition of speculation is you take a position based on a hope that the value of something will go up. Well, that's almost all financial transactions. And much speculation is beneficial. Not all. Some is harmful, but much is beneficial.
Okay. Thanks. Sir.
Hi, I'm Megan Tyvis. I'm an MPP1 here, and I would like to probe a little bit more on the international fallout of this whole thing. As best I understand it, the modern monetary system is premised on the idea that American dollar is a decent bet, and that particularly American sovereign debt is a decent bet. So my question to you is, do you think we're going to see increasing and deepening fallout in the international economic system as foreign investors do shift away from American assets, or do you think that sort of America's position as the linchpin of the international economy has already declined sufficiently with the rise of the euro and other currencies that that's not a problem, and the financial system, the international financial system, can weather it?
I feel like I'm dominating too much, but I'm the international guy up here, so I guess I have to answer. Most economists will tell you no, but I will tell my answer is yes. I wrote a paper 3 years ago with Menzie Chin doing some detailed econometric analysis on the question of international reserve currency status, how central banks hold their foreign exchange reserves between dollars and yen and euros. Based on past evidence and then looking at some future scenarios, we predicted that the euro, which that is now a credible rival to the dollar, could reach a tipping point where it surpasses the dollar by 2022 was our point estimate under one plausible scenario. We recently updated that and we got 2015. And that was before the most recent crisis. So I actually think it could happen. And that would just be one manifestation of a larger phenomenon. Now, in terms of financial centers, is New York lost its primacy, lost its credibility? It's lost a lot of credibility, but the only other major rival is London, which is hurting just as bad. So I don't necessarily see that happening right away.
Okay. We have time for one last question, and it will go to gentleman.
Hi, I'm an MBA at Wharton Business School and MPA here at the Kennedy School. My question is, what do you, can you comment on the possible moral hazard problem in the intervention and bailout? Are the people who took a mortgage subsidized at 95% gonna learn from this crisis, and people in Wall Street gonna learn from this crisis? And is it not actually a way of making up for the mistakes that the regulators and Congress and whoever is responsible did, and passing it over to the next administration or to the next generation until the next crisis comes?
Thank you. I think it's very hard to figure out what people are going to learn from this crisis. And I think the usual stylized fact is that avoiding bank run type phenomenon tends to be more important than engaging in a little bit of moral hazard creating activity. Going forward, the key is to have some combination of regulation and taxes, and I don't know if Jeff's idea of a transaction tax is the right one, but some combination of regulation and taxes that actually charges financial institutions for the risks that they impose on the rest of us. That's how regulation should be thought about. And I would be happier if Jeff had actually advocated the transaction taxes for the reason that this was actually getting them to internalize the external effects, the costs on the rest of us of their actions, and that we just use the stocks or throwing fruits at people to actually satisfy the government, the public hunger for retribution towards Wall Street tycoons. But I mean, that's going forward. We really shouldn't, and this is really the point, actually. I mean, the case for limited government is not that the private market works so well, but the government's going to screw it up, right? That's the case for limited government, and that's really the right way to think about what's happened in the past. Is not that there's been too little government or too much government, but it's been the wrong kind of government. It's been government that's often been making the problems worse rather than making the problems better. Going forward, the objective really has to be to think about interventions, and there really needs to be them. I mean, we really need to take steps that will limit the possibilities of things that require $700 billion checks, even though the cost will be considerably less than $700 billion. But that really means, you know, using some combination of regulation, and I think fees as well, to prod financial institutions to internalize the costs of the risk that they impose on everyone else.
Diana.
Yeah, you know, it almost, the thought came to my mind that it almost doesn't matter exactly what we do to get ourselves out of this, because we've all agreed that it's a crisis of confidence. So that if people are confident that whatever we do is going to address the issue, then we've addressed the issue by restoring confidence in a reasonable regulation. My colleague Floyd Norris at the Times had a wonderful line in one of his columns about this mess, saying that the lesson we should take from this is if something is big enough to destroy our financial system, it's probably big enough to be regulated. And the failure of this situation was that there were things that were big enough to destroy our financial system that we thought shouldn't be regulated. Well, that's one lesson I'll take from it. That if you're doing something that is capable of blowing up our financial system, don't tell me that it will interfere with you if we regulate you, because I'm not going to buy that. The test of the next year is going to be that we don't go regulation crazy, that we figure out not more government or less government, but just enough government and smart enough government to effect this end, which is a financial system that we trust again, that we have confidence in again.
2 points. One, to your first original question, I think as Ed said at the beginning, when moral hazard meets systemic risk wins. We tried more, you know, we tried to worry about moral hazard, or Paulson tried to, in dealing with Lehman. And that worked for a day or a half a day, or not even a half a day. On the broader issue of regulation, I think the challenge is to find regulations which give the private sector, this is to me at least, the right incentives to prevent this from happening. And that's complicated. It's much easier to intervene by per se regulation saying you will not do this. But I think the right approach, and that's going to be the challenge over the next year, 2 years, is to find ways by regulation to give the markets the right incentives so that they don't get themselves to the same place.
So I just wanted to say amen to what my fellow panelists have said, particularly that it's not more regulation or less regulation, it's smart regulation rather than dumb regulation. And on Bob Glauber's last point, that when moral hazard meets systemic risk always wins. My way of saying this is there's a popular saying, it's not literally true, but there's a popular saying, there are no atheists in foxholes. Well then, if there's no atheists in foxholes, there's no libertarians in financial crises.
Well, please join me in thanking our panel for a delightful evening. Many of you are aware that there will yet be another event tonight here in the forum. We have been asked to invite you to leave promptly and as efficiently as possible. If you want to stay for or want to attend the vice presidential debate that will be broadcasting here, the doors will reopen at 8:30 and you can come in and find your place then.